Hey everyone, welcome to the Real Estate Investment Podcast with David Chehade, CEO and founder of Real Estate Investment Finance. And today I'm super excited to have Chris Smith with us. Chris comes on an extensive accounting background, over 26 years, got his master's in accounting and helping thousands of clients over the years with all things tax. They say tax isn't sexy, but today we're making it sexy. We're going to chat tax strategy. How do we get more of that money in our pocket? They talk about tax being one of those things where there's only two things that are certain in life, eh? It's either death and paying tax. But how do we reduce our tax legally? How do we get us up in a better position? So guys, today we're going to be chatting to Chris, world full of knowledge, to see how we can get some of that back into our pocket. You know, we were talking earlier, Chris, most people work over 1 day, about 1.5 days on average a week, just to pay the tax man. It's wild, isn't it?
Yeah, you're right, mate. 1.5 days. It's pretty depressing to think about, but you know we've all got to pay tax in Australia. But let's work together and help your clients and your people watching the podcast to save tax.
Amazing. So how can Aussies get more tax money back in their pocket through investing? How does that work?
Well, investment in property is very tax effective. It's one of the best tax effective vehicles that there is. Basically, when you purchase a property, you're able to claim all the running costs and interest deductions associated with purchasing that property. What does that do? That reduces your taxable income. And what does that do? That increases your tax refund. That's a good thing for most people. The key is, this is the tax department legislation we're talking about. They're not going to tell you what you can and can't claim. And you're going to leave a lot of money on the table if you don't claim everything you can. So it's very important that you are in touch with a professional and know everything that you can claim so that you do not leave that money on the table. So, yeah, we work together with a lot of clients to make sure that we claim absolutely everything that's allowed. One of the biggest deductions that is left on that table is depreciation. It's a non-cash, genuine deduction. And in a lot of cases, it can be quite huge and make a big difference to your tax refund. Non-cash depreciation works as follows. There's capital works depreciation, which is the depreciation allowable on the building cost. That's at 2.5% over 40 years. Then there's the plant and equipment depreciation, which is allowable, which is carpets, air conditioner units, all those sorts of things which you can claim a tax deduction on. Now, these are non-cash items, so it's not out of your pocket. It's just an allowed deduction that you're allowed to include in your tax return and obviously increase your refund.
That's massive, isn't it?
Oh, it's huge.
Most people, when they typically do their tax returns, they're thinking, okay, great, I earn a certain amount of income. What can I deduct off my tax return to reduce it? And that's usually money that they spend on items.
It's a big gold mine.
Yeah.
For example, if you kind of allowed to claim $7,000 in capital works deduction, the building cost depreciation, and say another 11, 12 grand in plant and equipment depreciation, that could equal $4 or $5 tax refund that you're just missing out on,
which is
based on the
huge.
marginal tax rates in Australia.
And that's money they're not actually spending, but the ATO is allowing you to
Correct.
claim. How cool
It's
is
an
that?
allowable claim.
Yes.
The ATO are not going to say, hey, David, you forgot to include your depreciation in your tax return. That's not the way the system works.
The average Australian doesn't know this out there. They don't understand how this works.
Correct.
So it's massive, isn't it?
It's huge.
And
It's
how
huge.
does it work when it comes to the different property types that the clients can buy, and how, is this applicable, and does it relate to a different, depending what they purchase?
Yes, good question.
Yeah.
Thank you.
Yeah.
Well, new builds.
Yes.
So newly constructed property has the greatest deductions as far as depreciation is concerned. You're allowed to claim, again, the capital works deduction costs at 2.5% on the build cost, as well as the plant and equipment depreciation, which is at different rates depending upon what piece of item it is, carpets, air conditioners, etc. With a second-hand purchase, the ATO on the 1st of July 2017 no longer allowed any deductions as far as the existing plant and equipment, or if it's already been built and it's been claimed as a depreciation item. So it's very important that you are selective with your property that you select, because obviously new builds, there's a lot more depreciation deductions there, which is again a non-cash expenditure deduction. So you need to be very careful with your selection there, because unfortunately the ATO ruled out those second-hand purchase deductions in 2017. You can still claim the build cost at 2.5%, but those plant and equipment deductions, which are usually a lot higher, at a higher tax rate, have now been removed. So yeah, it's very important that you assess those things.
Huge, eh? And,
Yeah, it's huge.
You know, a big thing is as well, you know, we tell our clients all the time, it's like, you know, you make a decision when it comes to investing based on the numbers, not on emotion. And we find a lot of people, when they're looking to invest, they're feeling into what feels good, and it's the house up the road that they can see and view, and
Yeah.
it's not the numbers. And, you know, it's realizing that the numbers are what you're doing it for. It's the passive income, it's the financial goals. And, you know,
100%, mate. Because you just said earlier on, you work 5 days a week, and you know, 3.5 of those days you get to keep the money.
Yep.
In essence,
Yep.
After tax. Wouldn't it be nice to, you know, you got to create that position for yourself when you get older.
Yep.
You get older, you get tighter.
Yep.
You don't have the energy to work as you used to. So you need to start creating that passive investment income stream
Yes.
as young as you can.
Yes.
So that later on in life you can just sit back and put your feet up.
That's what it's about, being able
That's
to
what
have
it's
that
about.
freedom to live life on your own terms. And looking at the depreciation and the tax benefits that you can get on a new versus an old, we always say, well, compare the numbers. What's a better property to buy? And we do find being able to claim those additional deductions, you know, in some cases, the property could be $200 a week out of pocket instead of what could be $400 because you're not able to really maximize them. So it all comes back down to, you know, the numbers and driving
The
those
numbers,
best decisions.
obviously, when I do a lot of tax returns in the property investment space.
Yep.
New builds, obviously, you're not going to have much in the way of repair and maintenance.
Yes.
You're not going to have all those worries with the used property that you would have.
Yep.
As we discussed, you're going to get larger tax deductions equals larger refund. And at the end of the day, it's also about property growth.
How good. So average person earning $100,000 a year, give us a practical example on how buying a new property can help them reduce tax and what it means on their bottom line. Just some rough indicative figures.
Rough indicative figures.
Yes.
So for this year, for example, if you're in that example, $100,000,
Yes.
you purchase a property with the depreciation, all the other allowable deductions that you're included in your tax return.
Yes.
If that has a, say, overall available deduction of $20,000, your new taxable income is $80,000, right?
Wow. Yep.
That means you're only paying tax on 80,000, not 100,000. So roughly speaking, the tax rate there is effectively 34 cents in the dollar. So in that example of that 20,000 deduction, you'll roughly get 6 to 6,500 back on
How
your
good is
return.
that?
Obviously, we're just talking rough numbers here,
Yep.
but yeah, and what do you do with that money? Obviously, that's going to lead into a little bit further down the road with us, but yeah, you can certainly use that money to pay down your principal place of residence and
Yes.
do other things like that.
Yep. Amazing. How good's that? So if I got that right, you can get 20,000, let's say on that example, tax-free by owning one investment property after it's geared negatively.
Correct.
So let's say you had 2 or 3.
Oh,
Can
yeah.
we amplify that?
You can amplify it,
Yes.
100%.
Yep.
So if you've got 3 properties
Yes.
and they're negatively geared to, say, in this example, 60 grand,
Yes.
you're certainly going to amplify your tax refund.
Yes.
And, you know, you're going to put yourself in a position where you've got 3 properties, which in essence, you've got the ATO assisting you to pay off
Yes.
or contribute to your future investments.
Yes.
So it's a gimme from the tax
So
itself.
on that example, owning $100,000 a year, you could pay tax only on 40, having 60 tax-free by being able to have 3.
Correct.
That's massive.
In that initial, obviously at the first few years, the
Yes.
depreciation is higher
Yes.
with a new build,
Yes.
obviously, and that will obviously go down as the years go by.
Yep.
But yes, you're correct. So it's a really good vehicle to start, in essence, stacking properties to put yourself in a position where, as we discussed previously, you're set for your retirement.
Love that. Now, you mentioned earlier funneling that money into ways to build wealth. What's the optimum loan structure to be able to maximize tax deductions from your experience?
From my experience, it's having an offset account.
Yep.
Now, the key with an offset account, meaning you'll have the loan and any additional payments that you want to make, you'll put into that offset account. Now, remember, the investment loan, the interest is 100% deductible on an interest-only loan facility.
Yep.
There's 2 types of loan facilities, principal and interest facility. Most investors will do an interest-only facility initially. Why do they do that? Sensible advice to most people is to do that initially is to maximize your interest deduction and also give you that extra income in your pocket in that offset account so that you can target, say, for example, your principal place of residence.
Yep.
There's no tax deduction on that loan. So focus on targeting that, or pivot and start examining additional properties with that additional cash flow you have. So the offset account does give you the capacity to use that money as and when you wish. I don't advocate for paying extra initially against your investment loan, because what happens from a tax accountant's perspective, which makes it a bit of a difficulty for us, if we're trying to calculate your interest deduction on your loan and you've put some money in, taken some money out, buy something personal, it makes it really difficult for us to calculate, well, what is the allowable deduction? Because from the ATO standpoint, any loan, they don't care what way it's structured, it is all, the tax deduction relates to what is its purpose.
Yes.
Okay, so if its purpose is only 80% related to the property investment and 20% you went and bought a boat, then obviously only 80% of that loan is going to be deductible. So it does keep it very simple. If you have an offset account, there's no restrictions on you pulling the money back out. But what happens in an offset is obviously you're not paying interest.
Yeah. And what are we offsetting? Home, the investment?
Well, you want to offset your home loan first and foremost, because that's non-deductible debt.
Yes.
Non-deductible debt. After that, after you've obviously worked very hard and paid off your home loan or paid down a fair lump sum of that, you also want to continue to target additional sensible investment property acquisitions to continue growing your property portfolio.
Brilliant. And principal and interest on investments versus interest only?
Yeah, P&I. So as I said before, what's happening with a P&I is you're paying down a little bit of the principal of the loan whilst you're making the repayments. The repayments are higher. So it does impact your cash flow and your day-to-day living. Interest only, the repayments are lower. And obviously why most investors like to move into that space, as I said, is it gives you that more flexibility with your cash to make considerations about, as I said, paying down your PPR, principal place of residence, or making future investments. It doesn't tie you up, so to speak.
Makes sense. That additional cash flow you want to be able to funnel into the offset to pay that home loan
Correct.
as quick as possible.
Correct.
Because you're not getting your tax deduction there.
That's right.
The top priority.
Top priority.
And that's how we can see people going to pay their mortgage off instead of the typical 30 years that the banks want to tell you to do it, where we can see them paying it off in 7, 10 years and sometimes less by having those right structures there. So
correct. And obviously, as we discussed with those tax deductions you're speaking about, if you're getting an extra 5, 10, 20 grand in your pocket, you're going to direct those funds towards that principal place of residence if you have that debt. Again, as you said, it's the non-deductible debt. Yep. And it basically enables you to snowball the effect of paying down your principal place of residence and building your asset portfolio.
Brilliant. We're going to wrap up with ATO changes. Anything recent we should all know about? What's happening in that world that might impact investors in terms of what they can deduct, structuring their loans, any updates in that world?
Yeah, the ATO, obviously, they're always considering what people are claiming as tax deductions, right or wrong. But what's changed lately? They are specifically targeting purpose of use loans at the moment. What I mean by that is, as I discussed previously, muddying the waters a bit with your investment loan, meaning you draw down some personal use debt on that investment loan. They're starting to target those areas to make sure that you're not claiming 100% of the interest costs on that loan when in essence you might have gone and bought a boat using 100K out of that investment loan facility. They're big time targeting that. They're targeting also depreciation as well. That's why I highly recommend, and so do you, to get a depreciation schedule report done by a quantity surveyor so that you're not overstepping the boundaries of what you can and can't claim.
So many investors don't know that. They don't have them.
When the property's built, or when you acquire the property, please can't emphasise enough, it's a one-off cost. Yeah. Well,
tens of thousands of dollars left on the table by not doing that one step.
They charge, $500-$600, yes, and it's going to save you thousands and thousands of dollars.
The importance of having the right accountant on your team as a property investor. We always talk about having the right team there. You need the right mortgage broker. You need the right accountant. You need the right solicitor. You need the right property team. You need the right surveyor. And not having the right team that specialise in property investment can set back investors tens of thousands of dollars in losses because they don't know these little hacks. So
correct. It's as I said previously, the ATO doesn't tell you. The legislation is there. It's up to us to communicate to our good clients what's sitting there, what's available for us to claim, and let's all get ahead together.
Big takeaway, guys, is have the right accountant on your team. Chris comes with a 26 years of experience and helps investors structure this up correctly. Chris, we didn't know tax can be sexy. We've made it sexy today. Money's
it's as sexy
sexy.
as it can be,
It's
Dave.
sexy when we can help our clients put more money back in their pocket. Our listeners be able to see how they can, be better off by tens of thousands of dollars. So thank you for your wisdom. Thank you for your knowledge. And thank you for your time today.
Well,
Really
thanks very much
appreciate
for
it.
having me, Dave. It was great.
You're welcome.
Thank
Thanks,
you.
Chris.